For you to understand how I truly trade, right? How I truly trade with pairs trading or crypto pairs trading, you need to understand one of the most important concepts of pairs trading, and that is correlation, right? You need to fully understand what correlation is and how I personally use it in pairs trading, and some of the important points you need to get when it comes to correlation and pairs trading. So if you are ready, right, get your writing material and let's get to it. I'll be seeing you in the lecture room.
So welcome to the classroom. By the end of this video, you should be able to define what correlation is. You should be able to know and identify positive and negative correlation. You should be able to understand correlation coefficient and be able to recognize the correlated market and understand why correlation matters in pairs trading or matters in statistical arbitrage. Remember, I said pairs trading is um, an aspect of statistical arbitrage. You should be able to understand that. So, like I was saying, one thing that completely changed the way I look at the market was realizing that some assets are connected. They are connected not randomly, but statistically, right? Once I understood that, I stopped looking at the chart the normal way because most traders, right? Most traders only focus on price, but best traders, right? We focus on relationship, right? And honestly, that mindset is what changes everything, like I said. So, in this video, I will explain one of the most important concepts behind pairs trading and statistical arbitrage, and that concept is correlation. So we'll be focusing on correlation in this class, right? We'll focus mainly on correlation. And don't worry, like I said, I'm not going to be giving you the chat GPT definition. I'm going to be giving you a practical explanation. So I'm going to be explaining with the simplest way possible, not complicated mathematics, although correlation has formula, not university kind of level statistics, but practical understanding, the way you will understand, the way anybody will understand. Because if you truly understand correlation, you will be able to see the market differently and you'll be able to follow up with what I am doing on this channel with the way I trade on this channel. Like I said, I'll be starting my the challenge how I would trade my last $300. And if you don't understand correlation, you will not understand when I start pushing the button. So what exactly is correlation? It is simple. Correlation measures how simply two assets move. That is it. That is literally it. It measures how two assets move, how two things move. That is what correlation measures. If two assets tends to move in the same direction most of the time, they are positively correlated. That is simple, right? Isn't it simple? When two assets move in the same direction most of the time, they are said to be positively correlated. Now let's look at an example. So we'll be using the chart, we'll be going on the chart, and this is the chart of GBP AUD and GBP NZD. As you can see that these two assets are moving in the same direction. So we call this positively correlated asset, right? Because they are moving in the same direction most of the time. Like if you look at this time frame, right, they are moving in the same direction. You notice how similar their movements are, right? You notice how similar when one goes up, the other one follows, right? It goes up with it. Not they are not really perfectly identical because if you go to other time frames, right, they are not perfectly identical, but they are clearly related. So when one, like I said, when one pushes higher, right, the other one follows. When one drops, as you can see, the other one usually react to. And once you start noticing this relationship, right, you realize that the market is much more connected than most people think. The market is connected, it's much more connected than what people think, right? So, the easiest way to understand correlation is to imagine two friends, right? Two friends working together. So let's say these two friends are going to a point, are going to a birthday party. You will notice that the two friends will be working together, right? They will be heading to the same location. So if one of the friend turns left, right, the other usually will follow because they are going to the same place. If one speed up, the other ones will also react. That is basically how correlated assets behave. And obviously, they they won't move identically every single seconds, right? Because they are different people, they have different mindset of their own, they have different ideology, although they are friends, right? So they don't move identical every single second. Sometimes one move faster, sometimes one moves low a little bit later, but overall their behavior remains related, right? And another thing you need to understand is that one of the first thing that made me interested in statistical arbitrage or pairs trading was realizing that the market is not just random candles, green and red candle moving up and down, but they are related. They are relationship behind price, right? Now let's look at um, types of correlation. There are different types of correlation. The first one is positive correlation. So this is when two assets generally move in the same direction. They move in the same direction. Some good example are Bitcoin and Ethereum, Euro AUD and Euro NZD, just like we saw previously. These are perfect example of positive correlation. So this is when two assets are moving in the same direction, right? So most of the time, if one rises, the other one would react positively. And this usually happen because those assets are connected somehow, right? They are connected somehow, and it may be due to they are connected maybe economically, maybe structurally, maybe through market sentiment, but there is usually a reason, right? There's usually a reason behind this relationship, right? We also have a negative correlation, right? We have positive, we have negative. This is when two assets move in opposite direction, just opposite of positive correlation. They move in opposite direction. One rises while the other falls, right? One rises, the other falls. But in positive correlation, one rises, the other one rises with it, right? So a common example is how the US dollar can affect major currencies pairs like gold. So you can see this chart, right? This chart of USD and gold. You can see that when the dollar becomes stronger, right? The price of gold is weak, right? So they are negative correlation. So some currency also gets weakened when we have dollar strength. So instead of moving together, right? Instead of moving together, they move against each other. And understanding this is important because relationship in the market are not always positive. You need to understand it. Relationship in the market are not always positive. They are negative sometimes. In fact, there is another type which is neutral correlation, right? Sometimes they move together, sometimes they move opposite to each other, and sometimes there are barely any meaningful relationship among them. So why does correlation happen in the first place? You might be asking, why does correlation happen? Right? Usually because assets are fundamentally connected, right? Because assets are fundamentally connected. Just look at an example. Let's take GBP AUD, GBP NZD as an example, right? Both contain the GBP pounds. You can see GBP AUD and GBP NZD. They both contain GBP pound, GB British pounds, and Australia and New Zealand economy are closely related. So I'm going to be doing a video on this, like a single video on this, why pairs are connected, right? But not today. So I will not be talking too much about this now. I'll be talking about this later. So, but bear in mind that assets are connected. The reason why assets are connected, are behaving this way, is because there's a relationship between this asset, right? There's a relationship between asset. GBP is here, GBP is in the other one, in the other pair. So they tends to move in close relationship with one another, right? So naturally, these currencies are often, they often behave similarly, right? So the same thing happen in crypto, right? We have Bitcoin and Ethereum. They are both heavily influenced by the market sentiment. They are influenced by fear and greed, or then the overall crypto momentum. So when this crypto market, let's say for example, Bitcoin, right, the leader, becomes bullish, both assets, right, or every other asset will often rise together with it. That relationship is not random, guys. It is not random. It is a it that is a that there's a logic, right? There's a logic behind this. There's a logic behind this. Now, this is where pairs trading starts becoming really, really interesting. Most traders focus only on direction. They wake up every day, right, asking themselves, what should I buy? Or they ask, what should I sell? But pairs trader, we think differently, right? We think differently. We ask, are there assets, or are these assets behaving normally related to each other, right? We ask these questions. Is there a relationship between them? What has happened in this between these two assets? That is a completely different mindset, because now we are not just watching price movement going up or down. We are studying behaviors, right? We are studying relationship. And when two assets or two correlated assets suddenly stop behaving normally, that gets our attention. It gets our attention, and that is where we are open, right? We are taking our trades from there, right? So let's take for example, imagine two assets that usually move very similarly, then suddenly one becomes unusually strong, uh, or uh, or unusually weak. That temporal imbalance becomes interesting, right? It becomes interesting because sometimes relationship drift temporarily before stabilizing again. And this idea is one of the foundations of statistical arbitrage. Now, this is not predicting random direction, but studying temporary inefficiency between related assets. I hope you are still taking notes. So let's continue. That is one reason, right? That is one reason I always say best traders, we don't trade, rather we invest. We as best trader, we invest, we don't trade. So because we are not chasing random movements every hour, we are patiently waiting for the relationship, right, to become inefficient. To become inefficient. But here is something very interesting you need to understand, right? Because I've got a lot of people asking me which pairs are correlated, which of the pairs. No, guys, correlation alone is not enough. Correlation alone is not enough. I use correlation as pet trader. We use correlation, but correlation alone is not enough. And this is where many traders misunderstand the market badly. So just because two assets move together, just because Bitcoin and Ethereum and every other crypto market move together, doesn't mean that they will always move together forever. Relationship change, market condition change, just like we have the war, right? The Israel, Iran, US war, right? It causes a lot of market changes, right? Volatilities in the market changes every time. Economic condition changes. And that is why deeper concept matters, because the real question is not just, do these assets, do this crypto, do this currency move together? The real question is, how stable is that relationship over time? And trust me, that question become very, very, very important later. And one of the things I've noticed about successful trader is that they stop reacting emotionally to every candles. Instead, they start observing the market differently. What do they focus on? They focus on relationship, they focus on probability, they focus on structure, they focus on behavior, right? They focused on behavior. I said the last time in my previous video is I said that most traders don't have a structured way of entering, of getting into a trade. They just enter. They just say market going up, they just buy. That mindset shift is what changes everything for me. And honestly, this is one of the reason I became more interested into like Excel and data analysis. Because once you stop guessing, right? Once you stop guessing, you start wanting structure. You start wanting structure. You start wanting evidence. Start wanting logic behind decision. And the truth is, most people approach trading emotionally. They want constant action, they want constant excitement, they want to take trade constantly. Okay, I was once there, because if anytime I just remember that I have money with my broker and I am not in any trade, I will just want to take trade, and that is not good. So statistical arbitrage and pairs trader or pairs trading taught me to be patient. Sometimes, right, the best thing to do as a trader is to wait. I take it again. The best thing to do as a trader is to wait. Or the best trade you can take as a trader is no trade. Wait for imbalance. Wait for deviation. Wait for divergent. Wait for your opportunity. And honestly, I think that mindset alone can improve your trade, right? It can improve your trade as a trader significantly, right? You need to be able to wait for your setup, and remembering that correlation is not enough. There are other concepts that are more important than correlation. So in the next video, I'm going to explain why correlation alone can actually mislead you as a pest trader, or as someone who is getting into pest trading. Correlation can mislead you because many people use correlation incorrectly. And trust me, this is where things get even deeper. So if you enjoyed this video, or if you enjoyed this class, subscribe and follow this series. We are just getting started. We are just getting started. Because if you understand this, you'll be able to understand the series, the trade or the live trading section, which I'll be starting, how I will trade my last $300. Right? So I'll be talking to you in the next one. Until then, bye.